In this video, I'll walk you through how the CCI indicator works and how to use it for trend detection and pullbacks. By the end, I'll share the backtest results of the dual CCI strategy. Let's dive in. The Commodity Channel Index, or CCI, is a momentum indicator. It works by comparing the current price of an asset to its average price over a certain period. This comparison tells you whether the price is higher or lower than usual. Now, let's add the CCI indicator to the chart. Go ahead and search for CCI. Choose the Commodity Channel Index from the list of indicators. The default length is set to 20. This means the CCI will compare the current price to the average price over the last 20 periods. In other words, it calculates how much the price is deviating from its average over that time frame. And the source HLC3, which stands for the average of the high, low, and close prices for each period. This provides a smoother view of price action. Now, after adding the CCI to your chart, you'll notice the indicator line fluctuates above and below a center line, which is typically set at 0. When the CCI goes up, it means the current price is higher than the average price over the last 20 periods. When the CCI goes down, it means the current price is lower than the average price over the last 20 periods. One important thing to know about the CCI is that it is unbound, meaning it doesn't have a fixed minimum or maximum value. The CCI can go as high or as low as the market moves, giving you flexibility in interpreting its signals. Let's look at how traders use it to make decisions. There are two main things traders look for. 1. Overbought and oversold conditions. 2. Market trends. Let's dive into each one and see how it can help you trade. The CCI is most commonly used as an overbought, oversold indicator when traders apply shorter look-back periods, like 20 periods. When the CCI goes above plus 100, the price may have risen too quickly. Traders might decide to sell or wait for the price to pull back before buying again. When the CCI drops below 100, the price may have fallen too far. Traders might see this as a buy signal, hoping the price will bounce back up. These signals give traders a heads up that the market could reverse soon, allowing them to act before the price changes. Trend detection. When you use a longer look-back period, like 100 periods, the CCI becomes a powerful tool for detecting trends. When the CCI stays above plus 100, it indicates that the market is trending upward. This sustained movement above plus 100 suggests strong bullish momentum, and traders often interpret this as a sign to consider long positions or continue holding their current positions. The dual CCI strategy. Now that we understand how the CCI works, let's dive into the dual CCI strategy, which combines both long-term trend detection and short-term pullback signals. For the long-term trend, we'll use a 110-period CCI. This will help us identify the overall direction of the market. When the 110-period CCI stays above plus 80, it indicates that the market is in a strong uptrend. This is the first sign we need to look for before considering a trade. To fine-tune our entry, we'll use a 5-period CCI to detect short-term oversold conditions during pullbacks. We'll watch for the 5-period CCI to dip below negative 100. This suggests that the market is temporarily oversold within the uptrend. Our long signal occurs when the 5-period CCI crosses back up to negative 100. This crossover tells us that the pullback might be ending, and it's a good time to enter the trade. For exiting the trade, we'll manage our positions and protect our profits using an ATR-based stop loss, combined with a risk-reward ratio of 2 for take profit. This approach helps us stay in the trade as long as the trend continues, while also setting a clear profit target that's double the risk we're taking. Let's look at another example to make the strategy even clearer. When the 110-period CCI stays above plus 80, it indicates a strong upward trend. Now, we wait for the 5-period CCI to pull back to negative 100, and we enter the trade. Then we use an ATR-based stop loss, with a 2-to-1 risk-reward ratio for take profit. We can see that it's a winning trade. Now that we've covered how the strategy works, let's talk about how we can optimize the parameters for better performance. I tested the strategy on a 1-hour time frame using 2 periods. First, We have the in-sample data, which covers 8 months. This is where we find the best parameters for the strategy. Next, we move to the out-of-sample data, which covers 4 months. After optimizing the strategy, we test it on this period to see if it works well with new, unseen data. To fine-tune the strategy, I focused on these key parameters: the lengths of both the long and short-term CCI, the thresholds for the long and short-term CCI, the ATR period, multiplier, and the risk-reward ratio for the stop-loss and take-profit. By adjusting these settings, we can make sure the strategy performs at its best. We're going to use Freqtrade, an open-source platform designed specifically for crypto trading automation. If you want to see the full tutorial on how to use Freqtrade, check out the link in the description below. Now, let's take a look at the backtesting results. We ran the strategy on the AVAX USDT pair, and here are the optimized parameters. The total profit is 276.34% with a 63% win rate. The maximum drawdown is 23%. And if we look at the cumulative profit line, it shows a steady upward trend. You can download the strategy code for further research by checking the link in the description below. If you found this video helpful, make sure to subscribe, hit the notification bell, and share it on WhatsApp, Facebook, or Twitter to support the channel. Thanks for watching, and I'll see you in the next one.